Okay, imagine this happens. Something really sudden, totally unexpected hits you, like a major storm damages your house, maybe a fire, or even, gosh, a significant theft.
Right. Awful situations.
And beyond just dealing with the immediate shock, the cleanup, the emotional toll, there's that nagging question. What about the money side, the financial hit?
Mm-hmm. And specifically, taxes.
Exactly. Can the IRS actually help? Can you get any kind of tax break for these losses that just came out of nowhere?
Well, that feeling, that sort of what now financial stress, is exactly why we're digging into this. We're looking at how the IRS handles these things. They call them casualty and theft losses.
Losses to your property that are, like you said, sudden, unexpected.
Right. And the potential good news here is that, yes, the tax code does have rules, a specific way you might be able to claim a deduction.
So this deep dive is really about the how. How do you actually calculate that deduction? How do you claim it? We're going straight to the source for this.
Yeah, our guides today are the IRS's own materials. We've got Form 4684, which is the key form for reporting these kinds of losses.
Casualties and thefts, I think it's called.
That's the one. And we're also looking at Publication 584. Think of that one as like a helper workbook, especially for figuring out losses on your personal stuff.
Okay, so our mission here is basically to break down these IRS rules, make sense of them, and show you the step-by-step process the IRS wants you to follow if you face one of these events and want to see if you can get that deduction.
Let's start with the basics then. What actually is a casualty or theft loss according to the IRS?
Good question.
So, a casualty, it's damage or destruction from something sudden, unexpected, or unusual. Think floods, hurricanes, fires, earthquakes, that sort of thing.
Okay, not just wear and tear.
No, definitely not. And theft is, well, pretty much what you'd expect. Someone illegally taking your property with criminal intent. If either happens, Form 4684 is your starting point.
And you mentioned that foreign has different parts. It's not all lumped together.
Exactly. It's structured. Section A is mostly for your personal use property, your house, car, belongings. Section B is for business or income-producing property.
Right.
Then there are special sections, too, like Section C for losses from Ponzi schemes, and Section D for making a choice about when to deduct disaster losses.
All right, let's dive into that first one then. Section A, losses on personal property. That seems like what most people might run into. This is where Publication 584 comes in handy, you said.
Yes, definitely. But here's where we hit a really big hurdle, at least for now. There's a major limit in place for tax years 2018 through 2025.
Whoa.
Generally, you can only deduct a casualty or theft loss for your personal use property if, and this is the key part, if that loss happened in a federally declared disaster area.
Wait, really? So if, say, a tree falls on my house during a bad storm, but it's not declared a federal disaster, I probably can't deduct that repair cost.
Under the current rules, that's likely the case for personal property, unfortunately. Unless you happen to have personal casualty gains in the same year, maybe insurance paid out more than your basis on something else that was damaged, those gains can be offset.
Right.
But for a net loss, usually needs that disaster declaration.
Wow. Okay, that's a huge limitation.
It really narrows the scope. But if you do have a qualifying loss, which mainly means a federally declared disaster loss right now, then Publication 584 is super helpful.
Right, because it helps you list everything out. I saw it has these really detailed schedules.
Exactly. It's like an inventory workbook. It has schedules, I think, 1 through 19, guiding you room by room, living room, kitchen, bedrooms, even listing types of clothing, jewelry, cars. It forces you to be systematic.
Okay, so you use the workbook, you list everything, item by item. Then what? How do you put a dollar amount on the loss for the IRS?
Okay, so for each piece of property damaged in one event, there's a core calculation. It's got a few steps.
Let's walk through them.
First, obviously, identify the item. What was it? Second, figure out its basis. This is really fundamental.
Basis, that's basically what you paid for it, right? Plus improvements.
Generally, yes. Cost plus improvements minus some adjustments, maybe. It's your investment. Pub 547 gets into the nitty-gritty, but that's the concept. Third, you need the decrease in its fair market value, or FMV.
Meaning what it was worth right before the event versus right after.
Precisely. For theft, if it's gone, the FMV after is 0. That drop in value is key. Fourth, factor in any insurance or other money you got back or expect to get back.
Okay, basis, value drop, reimbursement. Then what?
Then you calculate the initial loss amount. And here's the specific rule. You take the smaller amount, either the property's basis or the decrease in its FMV.
Whichever number is lower.
Whichever is lower. From that smaller amount, you then subtract the insurance or reimbursement. That gives you your starting loss figure for that item.
Why the smaller a basis or FMV drop? Seems counterintuitive sometimes.
Yeah, it trips people up. The idea is you can't deduct more than you actually invested your basis, even if the market value dropped more. And you also can't deduct more than the actual economic damage, the FMV drop, even if your basis was higher. So you're limited by both.
Okay, got it. So you do that for each item damaged in, say, the hurricane. Add them up. Is that the final deductible amount for your personal stuff?
No, not yet. For personal use property, there are still two more reductions that kick in after you've calculated that initial loss for the event.
More limits.
First, there's a $100 reduction per casualty event. Not per item, but per event. So the first $100 of your total loss from that specific storm or fire just disappears. It's not deductible.
Okay, $100 off the top for the whole event. What's the second one?
The second one is much bigger. It's the 10% of adjusted gross income AGI reduction. You have to take your total net personal casualty losses for the entire year.
Like for the $100 reduction?
Yes, after the $100 rule per event. And you subtract 10% of your AGI from that total. Only the amount of loss that's more than 10% of your AGI is potentially deductible on Schedule A.
Oof. That 10% AGI threshold sounds really high. It means even if you do have a federally declared disaster loss and you get past the $100 rule, if the total loss isn't more than 10% of your income, you still get no deduction.
That's exactly right for non-qualified disaster losses that somehow slip through, or if you're netting gains and losses. It really reserves the deduction for truly significant financial hits relative to your income. But
there's a but for the disaster losses.
Yes, this is crucial. The sources highlight special, more generous rules for qualified disaster losses. These are losses from those federally declared disasters we talked about.
Okay, what's different for them?
Couple of key things. First, that $100 reduction per event. For qualified disaster loss, it's increased to $500 per event.
More gets excluded initially then. $500 instead of $100.
Right. But here's the really important part. That big 10% of AGI reduction, it does not apply to your net qualified disaster loss.
Oh, wow. So you calculate the loss, subtract the $500 per disaster, and that amount is potentially deductible without needing to clear the 10% AGI hurdle.
Exactly. That makes a massive difference. The sources also mention some specific relief acts for past disasters, like certain hurricanes or wildfires had similar rules, sometimes even allowing the deduction if you didn't itemize. And the recent Federal Disaster Tax Relief Act extended some benefits for disasters declared roughly between early 2021 and early 2025.
So for those qualified disaster losses in that time frame, the path to deduction is, well, not easy, but much clearer. Calculate the loss, subtract $500, and that resulting figure is what you work with.
Correct. And another key benefit for qualified disaster losses, you can generally deduct them on Schedule A, even if you take the standard deduction for everything else. You essentially add the qualified disaster loss to your standard deduction amount.
Okay, that's a pretty thorough look at the personal property side, Section A. What about Section B? Property used for business or maybe rental properties?
Right. Section B handles losses on property used in a trade or business or held for producing income. The rules are different here.
How so? Is the basic loss calculation different?
The starting point is similar. You still look at the property's adjusted basis, the decrease in FMV, and subtract any insurance or reimbursement to find the initial loss amount.
What?
But those two big limitations from Section A, the $100 per event rule and the 10% of AGI threshold, they do not apply to business or income-producing property.
Ah, okay. So the calculated loss is more directly related to the final tax impact?
Generally, yes. It flows into the calculation of your overall business gains or losses from casualties and thefts. There's also a specific rule in Section B if business or income property is completely destroyed.
Like leveled. Gone.
Yeah, totally destroyed. Then your loss is simply its adjusted basis minus any reimbursement. You don't need to do the comparison with the decrease in FMV in that specific case.
Because the economic loss is your entire remaining investment, basically.
You got it. Section B then has a part where you summarize all these business casualty gains and losses, and the totals usually end up getting transferred to other forms, like Form 4797 for sales of business property.
Makes sense. Now, you mentioned a couple of other specific sections. Section C was for Ponzi schemes.
Yes, it's quite specific. Section C provides a sort of safe harbor, a simplified method for calculating theft losses specifically from those Ponzi-type investment schemes. It's based on an IRS revenue procedure from 2009.
That they have a whole section dedicated to it. Wow. How does that simplified calculation work? Is it easier than the basis FMV stuff?
It's different. It focuses on your net investment amount. You figure out your total qualified investment, that's your initial money in, plus later investments, plus any income they told you earned.
Even if it was fake income?
Yes, income reported to you minus any money you actually withdrew over time. That gives you your net amount stuck in the scheme.
Okay.
Then what? Then you multiply that qualified investment amount by either 95% or 75%.
Why the two different percentages?
You use 95% if you're not pursuing recovery from, say, a third party. You use the lower 75% if you are pursuing potential recovery from someone else besides the main perpetrator.
I see. So it estimates your likely actual loss.
Right. And then you subtract any money you did actually recover. The result is your deductible theft loss under this safe harbor method. But you have to attach a statement agreeing to certain conditions if you use it.
Okay. And the last special part, Section D. What was that one about?
Section D is about timing. It allows you to make an election a choice under the tax code, specifically Section 165I, for qualified disaster losses.
A choice about what?
You can choose to deduct the loss not in the year it actually happened, but in the tax year immediately before the disaster year.
Oh, so if a disaster hits early in, say, 2025, you could choose to deduct the loss on your 2024 tax return.
Exactly. This can be really helpful because it might get you a tax refund much sooner, providing cash flow when you likely need it most right after the disaster. Section D is where you formally make that election, or if you made it and change your mind, where you revoke it.
That seems like a really valuable option for people hit by major disasters. Okay, we've talked a lot about calculating the loss. And every time you mentioned basis or adjusted basis, you said it was fundamental. How do people actually figure that out? It sounds hard.
It is often the hardest part, honestly. Getting the basis right is absolutely critical. Your whole loss calculation depends on it. Publication 584, that workbook we mentioned, it actually includes Worksheet A, which is specifically designed to help you calculate the adjusted basis of your home.
Just the house itself. Not the contents.
Right. Worksheet A is focused on the residential structure. It walks you through adding up your original purchase price, certain settlement fees or closing costs, the cost of major additions or improvements you've made over the years, like adding a deck or remodeling the kitchen. These things increase your basis.
What about things that decrease it?
Good question. Things like depreciation. If you ever used part of your home for a business or rented it out, that reduces your basis. Or if you had a previous casualty loss deduction for the same property, that would also adjust your basis downwards.
And how you got the property matters too, right? Like inheritance.
Absolutely. The starting point for your basis calculation changes depending on how you acquired it. Purchase, inheritance, gift, building it yourself. The instructions for Worksheet touch on those different scenarios.
Man, that's a lot of record keeping, especially for a house you've owned for decades. It really highlights how complex this can all get. If someone is facing this after a fire or flood, it must feel overwhelming. Are there resources, places to get help?
Definitely. And the IRS sources themselves point this out. They know it's complicated. They list irs.gov, obviously, the specific forms and publication pages.
Like irs.gov form 4684.
Right. They also mention interactive tools online, free tax prep help through programs like VITA, volunteer income tax assistance, or TCE, tax counseling for the elderly, mill tax for military members.
Hiring a tax pro is always an option too, I assume.
Of course. And using your own IRS online account can help access past information. But there's one resource they give special attention to for people who are really struggling to resolve issues with the IRS.
Which one is that?
It's called the Taxpayer Advocate Service, or TAS.
Taxpayer Advocate. What do they do? Are they part of the IRS?
They are an independent organization within the IRS. That's a key distinction. Their whole job is to be your voice, to help you resolve problems you just haven't been able to fix through the normal IRS channels.
Independent within the IRS. How does that work?
They step in if you're facing significant financial hardship because of an IRS issue, or if you've tried to contact the IRS, tried to resolve something, and you're just getting nowhere, or maybe if you think an IRS system or procedure just isn't working the way it should.
And they can actually help fix the problem.
They can work within the system to help resolve it, yes. And their services are completely free. They also work to ensure taxpayer rights are protected. They talk a lot about the Taxpayer Bill of Rights.
That sounds incredibly useful. especially when you're stressed about a major loss and dealing with tax complications. How would someone get in touch with TAS?
The main website is taxpayeradvocate.irs.gov. You can find info there and look up your local advocate's office. There's also a toll-free number, 877-777-4778. Knowing TAS exists is, I think, almost as important as knowing the tax rules themselves.
Wow. Okay, so we really covered a lot of ground here, from understanding what counts as a casualty or theft to the really strict current limits on personal losses.
Unless it's a qualified disaster.
Right. Then through the actual calculation steps basis, FMV drop, reimbursements, and the $100 to $500 rule, and that crucial difference with the 10% AGI threshold for qualified disasters.
Plus the different rules for business property, those specific methods for Ponzi schemes, and the disaster year election.
And digging into how fundamental and potentially tricky figuring out your basis is, using things like Worksheet A for your home.
And finally, knowing where you can turn for help, especially the Taxpayer Advocate Service if you get really stuck.
We've essentially traced the how-to process from the IRS's own documents, Form 4684 and Publication 584. It really underscores, doesn't it, how vital good record keeping is. You need proof of the event, sure, but also proof of what you owned, what you paid for it, its value.
Absolutely. The documentation burden can be immense, especially after a traumatic event.
It makes me think back to those lists in Publication 584. You know, the schedules listing every little thing, room by room, clocks, pillows, clothes, jewelry. It kind of begs the question, doesn't it?
What's that?
Are any of us, really ready right now to document every single possession down to the last detail for tax purposes if, God forbid, the worst happens tomorrow?
That's a sobering thought. The sheer amount of information potentially needed is staggering when you think about it that way.
So maybe the biggest takeaway isn't just learning the steps on Form 4684 after something happens. Maybe it's appreciating the level of detail involved before you need it. And just as importantly, knowing that there are specific methods to follow, specific calculations the IRS uses, and that help, like the Taxpayer Advocate Service, is actually there if life throws one of those truly awful, unpredictable curveballs your way.